We good? Alright. What's good on a Monday? What's up, YouTube? It's me again. I'm back on your YouTube. I'm back on your faces with another gem drop. And so, today I'll be going through a very simple entry model just to have something for you guys to look out for. It's a Monday. The markets are not very hectic, and so this is something for you guys to go back and bake test as far as your own trading is concerned. And so it's a very simple strategy. It's based on the 4 hour or daily candlestick open and close criteria slash model. And of course, this is under the idea that you guys are already trading smart money concepts. And so it's a 5 rule based strategy, which is you first want to establish the trend and be clear on the direction of your market. And so in if we're creating higher lows and higher highs, then we're obviously bullish in the trend as far as smart money would like to define. And then you observe structure and the order flow, which is again an analysis on the directional flow of the market. And so what this speaks to predominantly is we want to make sure that there is a flow of orders and not necessarily us moving in a ranging market. And then secondly, you await the market to retrace, and then you await the 4 hour candle close, and then you execute based off of this. Now, I know when I read out the rules for you without giving you the whole explanation of the strategy, it doesn't give you enough context to understand what it is that we're talking about. So now I'm going to go into a breakdown of the strategy. You keep in mind the rules, and I'll break down the strategy, informing you guys as to what it is that we use in this case to execute our orders. It's an entry model. And so yeah, structure in this case, I mean, we have a break of structure over here. We've shot up. True to structure, we want to anticipate a pullback into somewhere below the 50% range, somewhere within this demand area. And then once we get down here, what we do is ordinarily we would have been having bearish candles bringing price lower to this point, and then at some point what we want to see, it's not going to happen all the time, but when it does, we jump in and we're in the money. At some point it's going to give us a candlestick, right? And this candlestick is going to define which is ideally the last down candlestick before we shoot back up. This candlestick is going to either tap into our point of interest or come very close to it, where the next candle will probably be the one that taps into it. But we sort of want to see something along these lines. And so the previous candle, the last down candle, it might not necessarily be that last down candle, because this candle might be bearish but close within the parameters of the model that we want to use. Nonetheless, for this instance, the following candle is going to be bullish. However, that is not very relevant to this model that we're using. And so we're going to take this candlestick, right? Assuming that the market is still in play, I just want to do this markup real quick. Assuming that the market is still in play, we wouldn't be seeing any of this, right? So this is the only thing that will be available for us as far as the market playing out is concerned. And so what we want to see is a candle like this, right? It's got a body, and then it's got its wicks. So what we do is that we take the upper wick as the top of the range and the lower wick as the bottom of the range. So the candlestick, including its wicks, is going to define the range for us, and this is clearly defined, as you can see over here. I'm just going to delete this because it's no longer necessary. And then it's defined as a very simple rule over here. The previous candle defines the range, and so this gray box is our range, right? And so what we want to see is the following candle's wick going down below the range. However, the open and close of the candle need to be within the range. And so this wick, right, which is the low of the candlestick in this case, because we're looking to take bullish trades, the low of the candlestick needs to take the low of the previous candle, right? And then price needs to push back up and close within the range that is defined by the previous candle. You understand? And so the body of the wick is going to be completely engulfed by the body and by the candle, the previous candlestick, including its wicks, right? So it's going to be like a reverse engulfing pattern. But it's something that I want you guys to have a look at, and I think you will be able to see that this is something that can be somewhat valid if you know how to execute on it. And of course, have the ability to be patient, sit on your hands, and hold your trades once you've taken your entries. And so in this case, this wick would have pushed back down and then it comes back up again. As soon as that happens, in this case, the close of this candlestick is going to be here. As soon as this happens, guys, it needs to be within this range. So we don't want to see the candle closing anyway above the range. Even if the wick, it does wick above the range, it needs to close within the range. As soon as it closes, you execute your buy, right? And then your entry is going to be right around there. You just move your stop loss to just below this candlestick, because we anticipate that price is no longer going to come here if it's serious about pushing up. This is them protecting liquidity. The orders that have been set in here, they wouldn't want anyone to take them out, and so they'll keep price above it. I mean, a lot of buying power needs to be introduced around this area to break a trend that was originally bearish, pushing it upwards, right? And so you get the general basis. And so whoever puts in money over here probably put money in over here. And whoever puts in money over here is going to want to protect this level so that his positions, his or her, or the institution's positions are not in a negative or are not in a drawdown. And so you execute your position here and then you run with them to take out the high. I just want to demonstrate it for you guys on an actual market. I was actually back testing it, but I don't want to come here and talk to you guys on the base of something that is not clearly and properly defined. And so in this case, it depends on how you see it. You might, okay, this is not clear, and so an entry wouldn't have been taken here. But I just want us to do a hindsight analysis. When you understand structure, obviously you would be aware that this is a bullish trend, and so we're clear on that. Our trend is bullish. Cool. Right, and so we know when the market pushes back, what we anticipate is a close within the previous range, however having liquidated. And so we had one over here, the first one, and so your entry would have been something like this. Long position, your entry would have been something like this. Your stop loss would have been just below. And ordinarily what I do is I target the 1 to 5. You won't always get a 1 to 5, but it's typically what I target, right? 1 to 5. Cool. So in this case, it would have played out. We would have held our trade until it gave us the money that we wanted, with a very decent risk reward, right? And so price kept on coming down, and so the important thing is to be watchful of the points of interest, right? The lows, the support and resistance areas, as far as retail trading is concerned, right? And so here it came back down here. It didn't give us an opportunity because we have very strict, we have very precisely defined rules, and we don't want to do anything outside of those rules. And then it pushed back up. It almost gave us an opportunity here, but instead of closing within our range, it kept on going up. And so we obviously come up to this area, and in this case you would have waited for that pullback, and as soon as you get a candlestick like this, it closes within the range that is predefined by the previous candlestick. You see what I'm saying? Let's make this purple for illustrative purposes and to kind of make it rather obvious for you guys to see it. This candle starts right up there and it ends right down there. And so your entry would have been at the close of this candlestick, which means it would have been here. Your stop loss slightly below, and you keep on pushing. You wait for your 1 to 5. 1 to 5, you close your trade, right? And then you've got a young pullback over here. This is very messy, and so you typically wouldn't want to take something like this, but we would have had something going on over here, This one is a very uncertain candlestick. You could have taken an entry there and you probably would have been stopped out because price did come below that. However, the very next candlestick did the same thing, closed within the range of the previous candle. For clarity, we're just going to draw it. Right, close within the previous range. We take our entry right around here, stop loss just below. In a case like this, you would want it to be just below the lowest candlestick, which in this case we're fortunate happens to be that specific candlestick from which we're taking our entry. And then we push for our 1 to 5, we're good in the money. Okay, there it is. It's already 1 to 5. You can take your partials here, leave 20% of your position running and see how far it goes. And then we've broken like that. We anticipate the same thing. We didn't get it over here, and then we kept on pushing up. We come down. We're looking for the same thing. We're not getting it. 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 Okay, we didn't get anything here. We're not getting anything so far. Yeah, we're not getting it anyway there. And then here we go. We found the young something over here. This is a royal gem, guys. You can see the strategy. But of course, we're not in the business of convincing people about things. If you wanna start implementing it, hey, all the merrier for you. This is beautiful in that it's even at a support area which I had predefined. We push up all the way. We're looking for a 1 to 5. This didn't give us a 1 to 5. I mean, if we continue to hold, it would give us a 1 to 5, but you probably don't want to see half of your wins being wiped out before you actually push up, unless you're an experienced swing trader, which is something that I'm going to get into a little later. But for now, when you start seeing your positions moving back, if it goes above 1 to 3 and it pushes down below 1 to 1, I think it's best that you take your positions and leave with what you got. Now we had another pullback, had a pullback. This close within the range is not very convincing, but the reason why this happens, guys, is because this is typically your support area, and so there'll be a specific area that is being protected by institutions where they don't want anyone to go below that area. And so we don't have an opportunity here. This would have left us. Of course, we've got partials running from over there, and here's something really nice. You probably would have taken this and been stopped out at break even, which is still cool because it's not a minus. You probably would have had something like this, and then obviously got stopped at break even. Still cool, not a big deal. And then obviously this would have been the next case. The range is over there. Yeah, this is something of a back testing session, so please don't mind this video being long. Enter over here, push for a 1 to 5, get stopped out. Oh, 1 to 5, there we go. Couple of candlesticks deep in the money. We're cool over there. So far we haven't had a losing trade. We've had break evens, which is not a big deal. Okay, we had these closing within one another. Nothing is really getting liquidated. However, this candlestick closes. Let's define it. Let's draw it out so that you see it, and it's not something that is spoken of in theory. There's our range. We shot below it, but we closed within our range. So we liquidated that low, telling us that we are ready, Malone, to start shooting up. Entry would have been here. Stop loss would have been here. Profit ratio already looking now. Entry would have been here. Profit ratio 1 to 5 in the money. Cool. Pull back, pull back, pull back, pull back, pull back. Nothing given here. Nothing presented. Nothing presented. Nothing presented. Something presented over here, but it was going to stop us on break even, obviously. This closed within break even. Cool. And then here's another opportunity. Close within the range. Closed within the range. And so it's beautiful when you're able to properly identify your trend, because it adds confluence and confidence. You're not afraid to take your entries when you see them being presented on the market. So entry would have been here, stop loss would have been here. One to five. Let's see. 1 to 5. And so you're making $250, risking $50 every time, every time, every time. It's the same jive. And here's another entry. Okay, this isn't really a pullback, and so I don't know if it's enough for us to go by, but we can see that it's clearly at a respectful, at a level that the market is insisting on respecting, which is around this area. Tapped over there, tapped over there, right over here. So it's communicating respect, much like this one. This one is also communicating respect for this level, and we have something like that. We don't even think twice about it, guys. We jump in. And so yeah, I think I'm just gonna play music in the background while I do more of these analyses to sort of add more confidence, or rather confidence, to you guys as far as this method of trading is concerned. Here's another level that looks something like a resistance, right? These lines are too thick for my liking. Here's another resistance that's being respected. Here's an area that liquidated. We would have taken an entry, probably not given us our 1 to 5, but nonetheless, let's do it for the sake of, you know, conviction. Entry over there. Stop loss just below. Stop loss just below. Here's a young 1 to 5. Right, if this takes you out, you would have taken the entry here again. Back testing with my friend. 2.3, looking for 1 to 5. It's going to make my charts a bit messy now. Yeah, this is quite a wait. But let's see if the market eventually got to it. This would have been a profitable trade. Pull back, pull back, pull back, pull back, pull back, pull back. In the money. Yeah, gold is doing the most, guys. Here's another entry. In the money. 1 to 5 would have been reached sooner than this one would have reached its 1 to 5. It happens at the top too, but I mean, we're not counter trend traders because we're not sure how long the market will keep on pushing back, and so we typically wouldn't want to take trades like this, like that. Here's another one. Probably would have been stopped out here. This is our first loss over here. This would have been our first loss over here. And I'm also just getting exhausted at this exercise. Yeah, 1 to 5 would have been too far, so it would have been our first loss. We strengthen the stump color so that it's clearer to get out there. Right, alright. This is sideways. I'm not sure we wouldn't take any of these. And then cool, when this happens, a high time frame resistance has been made, and so we do expect something of a reversal around here. If you were doing the analysis with me in the previous week, you would have seen that this is an area where we were expecting a sell-off. In a situation like this, You got this. Now this is a very high risk entry because we haven't had confirmation as to the bearishness of our trend, unless if you are looking at this as an internal change of character. But this is presuming that you had seen it, in which case even over here, just 1 second, even over here you probably wouldn't even know, okay, this would have still been an L. This would have been where you realize that the market is showing intent to be bearish, waited for that to happen, came down with it. Now that it's clear that the market is being bearish, liquidated that, gave it you an entry, you shut down. And so the beautiful thing is that it produces a very high risk reward. Here's another case over here. Make this purple. Excuse me. You make this purple. Would have taken an entry day. It would have taken us out. Oh wait, no. Why am I lying? Here's our range. It's defined by this candle. Our range is defined by this candle, and then this is the candlestick that closes within. Did it close within? It didn't. You probably wouldn't have taken that. So we keep on holding on to the partials of our sell position, and yeah, that's pretty much it. If you like this content, go check it out. It plays out very beautifully on Nasdaq as well. It plays out very beautifully on US 30. It plays out sometimes on, what is this, on your regular currency pairs, but a lot more on the daily time frame as opposed to the 4-hour time frame. And so when you have this jamming around, but on the daily time frame, as far as the regular currency pairs, particularly your majors, you can rest assured that this is a strategy that you can count on. Otherwise, guys, thank you so much. This would have been just for this bullish trend. This would have been how many positions that you took off the market? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, 10 entries on the way up, which means 10 times 5 is 50R, right? And 1 loss, so it's 49R on your risk reward. Excuse me, guys, I'm a bit tired. I think I'm gonna make iced coffee, but nonetheless, forgetting the lack of enthusiasm in this video, concentrate on what it is that you have just been taught, and then like and subscribe, guys. I'll continue to drop more gems like this on the basis of the interactions that I'm getting from you guys. If you guys are very happy with the content, let me know. If you guys have questions, drop me a DM, drop me a comment, and then I'll clarify what I'm able to clarify. If it requires a video, I'll drop another video as a response to whatever questions you guys have. But otherwise, from your boy Blue Flex FX, catch you next time. Out.